Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks recovered early losses after U.S.-China trade tensions re-escalated. Plus, Federal Reserve Chair Jerome Powell's remarks are impacting markets too. We're going to dig into those stories in just a moment. But first, there's just an hour to go until the closing bell. Let's take a look now at stocks. At the major averages, they're mixed here. The Dow's up about 410 points. Your broad gauge, the S&P 500 is up about 0.3%. Meanwhile, your tech-heavy NASDAQ is down about 0.2%. Let's welcome in senior reporter Allie Canal. Allie, what are you seeing so far in today's trade?
Well, like you said, Josh, reversing some of those earlier losses here. You're looking at a Dow that's up 400 points. We were trading firmly in the red for most of the early morning session. Same story with the S&P 500. We are now up around 0.3%. The NASDAQ, the only index to be in the red, but still off of the session lows, down around 0.2%. You mentioned Jerome Powell's speech earlier today, and investors were closely watching to see what Jerome Powell had to say, considering we don't have a lot of the economic data. We are in day 14 of the government shutdown. And Jerome Powell essentially saying that the Fed's views when it comes to inflation, the jobs market, that hasn't changed all that much. So that basically confirmed to investors that further easing is on the horizon. Now, considering that the NASDAQ is the only laggard here of the major indexes, that is one of the reasons why we're seeing the S&P equal weighted index far outpace the broad-based index, because a lot of those cap-weighted companies, your Nvidias of the world, that are heavily weighted in the S&P 500, they're not doing so hot today. So let's look under the hood of the NASDAQ 100. You're going to see Nvidia shares are off 3%, Broadcom down 2.5%, Amazon, Meta, Tesla also trading in the red. Interesting though, AMD is up 3%. Why? AMD just signed a massive deal with Oracle. AMD is a competitor to Nvidia, even though it is not nearly as big as Nvidia. We have seen AMD lock in a slew of deals, and we're really seeing that across the AI space. OpenAI in particular has signed deals with Broadcom, Nvidia, AMD, even Walmart earlier this morning. And it's this self-funding nature within all these tech companies, and that is fueling some concerns that we could be entering into bubble territory. If we take a look on a sector basis, you're going to see green across the screen. Again, tech, your only laggard. Financials, one of the top performers here, up around 1.6%. We did hear from a slew of big banks earlier this morning. JP Morgan, Goldman Sachs, Wells Fargo, all pretty much reporting solid results, although Wells Fargo was the only big bank to really trade positively today. And then when we talk about hedging, some of the things that we're seeing in the market, particularly when we look at the price of gold, we're seeing gold just continue to rally here. You have gold trading firmly above $4,100 an ounce. In fact, we heard from Bank of America's Global Fund Managers survey earlier this morning, and they said gold is now your most crowded trade. It's no longer that Mag 7 AI trade. So again, just interesting fodder here as we continue to track this risk on sentiment with equities, and at the same time seeing gold up as well. And then very quickly here, because we have the time, let's look at Bitcoin. Bitcoin has been on quite a wild ride over the past several sessions. We are down 7% over a 5-day period. October, it's typically seasonally a really strong month for Bitcoin, but we are only trading at around $113,000 a coin. Year to date, though, we are still up around 20% here, Josh.
All right. Thank you, Allie. Appreciate it. Well, Fed Chair Powell says downside risk to employment appeared to have risen. Yahoo Finance's Jennifer Schonberger joining us now with the details. Jen.
Hey there, Josh. Fed Chair Jerome Powell says the outlook for employment and inflation hasn't changed much since the Fed's last policy meeting in September, but that the downside risks to employment have risen and the balance of risks have shifted. Fed officials have penciled in 2 more rate cuts for the remainder of this year, and Powell's comments seem to reinforce that another rate cut is on the table at the next policy meeting slated for October 28th and 29th. Though Powell reiterated that policy is going to be set meeting by meeting and that there is no risk-free course for setting policy, given that the Fed is trying to navigate bringing down inflation while keeping a healthy job market.
I'll stress again that these projections should be understood as representing a range of potential outcomes whose probabilities evolve as new information informs our meeting by meeting approach to policymaking. We'll set policy based on the evolution of the economic outlook and the balance of risks rather than following a predetermined path.
Meanwhile, Powell said that the Fed may be getting to the point in the coming months where it can stop shrinking its balance sheet. That is allowing bonds to mature and roll off the Fed's portfolio, thereby decreasing the size of its balance sheet. The Fed's balance sheet currently stands at $6.5 trillion right now. That's nearly 60% bigger than where it stood at the start of 2020. Treasury holdings have been falling off at a rate of $5 billion per month, where mortgage-backed securities have been falling off at a rate of $35 billion per month. If the Fed's balance sheet grew in line with the economy, it would need to shrink by another $800 billion. And as for the dearth of data during this federal government shutdown, Powell says he's taking signal from state unemployment claims as well as ADP's payrolls, but that they are just a supplement to the golden standard of federal government data. He said that if this shutdown persists much longer, then the Fed is not going to be privy to receiving October data, which is going to make things a lot more challenging for the Federal Reserve. Josh?
All right, thank you, Jen. Well, U.S.-China trade tensions may be reigniting investor worries about global supply chains and inflation, but amid the headlines, Hennessy Funds' Josh Wine argues that the market's strength remains grounded in fundamentals and not froth. Josh, great to see you here. Let's start with those U.S.-China trade tensions, because it felt, Josh, like the two sides were talking, things were progressing, and then all of a sudden signals that maybe, tensions were ratcheting up. What are you to do with that? How do you navigate that as an investor?
It's a great question. I think as investors, we're inclined to do something. Like if we're not doing something, then we're doing nothing. And I think that, doing nothing is a decision. And I think that, that is an announcement on Friday about, trade tensions and 100% tariffs came out of nowhere. I think everyone had kind of come to grips. They had gone through the 7 stages of grief and realized that, okay, it's all good. And the market was reacting accordingly. And I think when the market is up this much, it emboldens the administration to float these ideas. They're kind of playing with the House's money. And obviously the market voted that we don't like this idea, and we've seen this sharp move higher since, yesterday and today.
I've heard some strategists, Josh, they put it like this to their clients. They say, listen, you're going to see some huffing and puffing, but at the end of the day, here's their bet. There's going to be a handshake and some type of deal, because the risk of not doing a deal and the risk of confrontation, it's just too risky for both sides.
Yeah, absolutely. When you step back, it's silly to think that somehow we're going to walk away from each other and nothing's going to happen, and we all have to be on our own. The two biggest economies in the world are going to have to get along, and it's obvious that they're going to figure it out. It's just, we don't know what it's going to look like, how long it's going to take, all the posturing, but we need them, they need us. Who knows who needs more? But
let me ask you another story today. Fed Chair Jay Powell speaking today, again expressing this concern about our labor market. I think investors heard that and thought, okay, rate cuts on the way, bet on it. Is that what you heard?
Yeah, that seems right. The 10 years kind of reacted ahead of this type of talk, coming down to the 4 range. And yeah, the signs have been there. And I think the idea is that Chairman Powell's been a little bit slow to fully acknowledge that, yeah, we're heading into a tough area. I think the idea that we need to wait for the data and then we'll react, I think doesn't sit well with people. I think the idea is, well, you should see what's coming around the corner and react ahead of it. And I think the market likes that. We've seen this bounce higher. But I think that all makes sense. I think everyone's on board with what he's saying, and I think they were there first, and he's following.
Speaking of Jay Powell, he has suggested when he talks about the market, you heard those comments of valuation. He kind of suggested we're a bit stretched here. You agree with that?
Yeah, I don't. If you're buying the market, then I would definitely agree. A lot has to go right, and it probably will, or it might. I think what's driven multiples to where they are makes sense. Growth and margin expansion. That's how you get a market, on a cap-weighted basis that trades at, 25 times. On an equal weight basis, the market of stocks as opposed to the stock market at 19 times, that doesn't seem crazy with the 10-year at 4 and likely coming down ever so slightly. I don't think the market's stretched. I think it's dicey if you're playing the index game, but I think if you're looking at stocks on an individual basis, not at all. And especially something like mid caps that are more like around 18 times.
Well, when you talk about mid caps, dig into that a little bit more. What do valuations look like? What does earnings power look like?
Yeah, I mean, valuation's at about 18 times, so I think of that as like a 5.5 times or a 5.5% earnings yield. So with a 10-year at 4, that's fairly compelling. But I think what you're getting it's not what you're getting, it's what you're not getting. So because it's mid cap or small, which we own in the fund as well, you're not getting large cap tech. You're not getting the price to perfection. So there's some value in that. You're also getting a lot of the names that are going to be beneficiaries of AI and what we talk about every day. But it's ultimately about diversification. You're having something that's a good complement to an S&P 500 index fund, which certainly has a place in someone's portfolio. But I think it's just what it's not.
If the Fed does cut, as investors expect, what kind of tailwind is that for the mid caps?
Yeah, we've seen it already. The more that rate cuts get talked about, and the more the bond market's pricing those in, the more it gives a bid to small and mid cap stocks. So yeah, definitely, it will be a huge help, and we're seeing it already. Days like today.
Before I let you go, let me get some picks too.
Sure.
BJ's Wholesale. Why is that a buy, Josh?
Yeah, so we own BJ's Wholesale in our Hennessy Cornerstone Growth Fund. So we're looking at stock price momentum, we're looking at valuation and earnings growth. So obviously that fits the bill. It's a nice defensive name, a strong balance sheet, great cash flow generation. It could be a beneficiary or a further beneficiary of things like AI, but forgetting about that for a moment, just a great operator taking market share from traditional grocery. And when gas prices go higher, people want to get cheap gas at BJ's. It's a great marketing tool. So it fits nicely in the fund.
One last pick, StoneX.
Yeah, so StoneX, we also own it in the Hennessy Cornerstone Growth Fund. So it's a clearing and execution for, investors that are trading in, fixed income, derivatives, a great operator, again, growth through acquisition, trades at about 16 times earnings. They've grown the company significantly over the last, several years, and they've done it the right way. A lot of value creation for shareholders, and hopefully more to come.
Josh, great to see you. Appreciate your time, those picks, sir.
Thanks, Josh. Appreciate it.
Coming up, Tesla stock saw a drop today, but it may be blaming General Motors. We can explain why. Oracle and AMD, they expand their partnership to scale up AI initiatives, ratcheting up competition with NVIDIA. And investors sinking their teeth into Domino's. We'll tell you what the popular pizza chain is doing. Those stories and more coming up. Two of Detroit's big three automakers hitting a speed bump with production plans, and Yahoo Finance's Praz Subramanian join us now with the latest. Praz, great to see you. Let's start on Ford.
Yeah, the automaker, so, we heard about the fire at the Novelis auto plant in New York. This is a big problem, right? More than half the aluminum supply for the industry comes from the Novelis plant, and Ford is the biggest user of its aluminum with the franchise F-150 pickup featuring all aluminum body panels. Now, the Journal reports 3-row SUVs are affected now too. So no comment from Ford yet on that, but Ford is looking to mitigate some things with other options. But, for other automakers, they rely on aluminum parts for weight savings like suspension systems and things like that. So it's going to hit several automakers here, and there seems to be no solution yet in sight for that.
Well, I'm a Ford guy now, officially.
I know. Ford is big on
part of the family.
And Ford is big on off-road, right? That's part of the deal.
Went with the Bronco. Talk about what is the strategy with the Bronco?
So yeah, we can talk about F-150, talk about three-row SUVs, talk about Bronco. What we're talking about is Ford CEO Jim Farley talking about how he wants to make exciting cars, and he wants to be the Porsche of off-road, right?
What is he? That's interesting.
Yeah.
What does Jim mean when he says that, the Porsche off-road?
So basically, he wants to have like these products like Raptor, Bronco Raptor,
which is a great looking
Ford,
car.
the Tremors,
Great looking car.
The Tremor F-150s, right? These are cars that you take anywhere off-road, and they also participate in motorsports. And he thinks that that's where Ford should be. The product should be in exciting locations, and also doing things like getting headlines for winning, right? And that will trickle down to the products and get people excited to buy them. He doesn't want to make boring cars, is what he's saying. But on the flip side, you still got to sell volume, right? And those are, for lack of a better, boring cars, right? So he has to thread the needle with, we're going to focus on these off-road adventures, these Mustang on the race course, but then also sell a lot of these Explorer SUVs, Bronco Sports, not the Bronco like you have, and things like that.
All right, so that was the Ford news. What about the GM news today? Because that was making headlines.
Yeah, this is a big one today. So GM said it's going to take a $1.6 billion charge to its EV business, right? It's reassessing things. 1.2 of that will be a non-cash special charges as a result of the adjustment of EV capacity, or I think factories, things like that. Another $400 million in cash to basically pay out contract cancellations, right? Like maybe you ordered some parts for batteries and you have to pay suppliers you don't need them anymore. So that's sort of what's happening now. We're going to hear about those charges, more about that next week in GM reports earnings. But it shouldn't come as a surprise, right? We saw the EV tax credit go away.
That's why I actually want to get your. I was going to ask you whether, when you saw that headline, do you think investors in the street were surprised, or no? Because what we know about the demand backdrop and the regulatory backdrop, and what we've heard from some other names, you knew this was coming.
Yeah, Ford did a 1.9 charge recently, so it's not a surprise. I guess that GM would do this before earnings, right? They're trying to get ahead of this, maybe just get the bad news out of the way, right? And as they reassess plans, but I think we might expect more automakers to come out with these charges, right? So VW, Toyota, all these companies that come out, earnings coming out later this month, right? And early next month, we're going to probably hear more of that because of the change in nature. Now, if you go to Europe, go to China, other places, that's not the case. EV penetration, EV sort of market share is rising. It's just the U.S. situation that's having a little bit of, I would say, a slowdown here right now, but maybe it'll change in the next couple of years.
Do we know if GM is repurposing capacity here in any way? Like, are they saying, okay, the plants that were pumping out EVs, we're going to turn that, flip the switch, hybrids, trucks?
Yeah, for sure, 100%. They are doing that in Michigan. I can't remember which plant. It might be the plant in Detroit, but what they're doing is basically paying money to convert the factory to not just have EVs, but also have hybrids and also gas power and their trucks too, right? Because they know what makes the most money. It's high margin trucks, high margin SUVs. They're doing that now, converting these factories that were going to be EV only. I think it's the Orion factory, maybe. I think that's what it is. Check me on that. But basically, you're exactly right. They're converting these things to make more, I guess you say, varied powertrains for their vehicles, in particular trucks.
Last question. If this is the kind of sort of like broad EV sector softness that GM seems to be suggesting, is that bad news for Tesla? If I'm a Tesla investor, I saw that headline, what do I think?
I think there's a bounce effect there, right? Because of the fact that, hey, if GM is struggling a little bit and they're reevaluating plans for their EV rollout or their EV just production, why wouldn't that affect Tesla, who is the biggest EV seller in the country by far and away? You could argue Tesla says, hey, we actually make these vehicles profitably. We have a lot of margin that we can cut from and still make money. We just introduced that cheaper Model Y standard and Model 3 standard. We're different than these guys. Our cars are our EVs built from the ground up for many years now. I think there's two sides to that, but I think overall that's not a good thing if one of the biggest automakers in the country is saying we need to pull back on our EV rollout.
Yeah, fair point. All right, well, GM taking $1.6 billion charge, as we were just talking there, due to EV capacity adjustments, casting a dark cloud over the EV industry. The automaker showing the potential negative ripple effects from the end of the federal EV tax credit. The state of GM weighing on the outlook for other EV makers, such as Tesla. For more on the road ahead, let's get to TD Cowen equity analyst Itay Michaeli. Itay, it's good to see you. So, GM, I was just talking to Praz about this. This was the headline today. They take this $1.6 billion charge, adjust its EV plans. It says it expects the adoption rate of EVs to slow, Itay. Was this a surprise to you, Itay, as a financial analyst covering this name, or given what you know about the demand backdrop, the regulatory backdrop, you saw this one coming?
Well, thank you for having me. This did not come as a surprise to us. GM has previously announced plans to alter its EV manufacturing footprint and capacity, particularly in the Orion plant, where we think some of this charge is probably concentrated in. That's a plant they previously were going to launch new EV pickup trucks, and they've already announced a shift to ICE vehicles, including pickup trucks and large SUVs. So to us, not a surprise at all. We do think that the charge should help improve GM's EV profitability over time. There is a small cash component as well, which typically happens when you have these things. But overall, to us, this seems just a natural kind of reflection of recent developments and the company's kind of shift in light of those developments. And the key point, too, is that GM should still have ample EV capacity. There is no change to their current retail EV portfolio that's on sale today. There's still ample EV capacity to meet demand when and if the EV demand does eventually recover.
So you say, hey, it's Pras. We're looking at GM's portfolio of EVs, and they still have a full portfolio here, right? They just had the new Bolt come out. You have all the SUVs. You have Cadillac doing quite well in the EV sort of landscape. What's your sort of outlook on what GM's going to do from a product point of view? I think they're probably set up for success, but at a certain point, how many of those can you sell?
Yeah, we do think they are set up for success. Now a solid number 2 U.S. EV market share position. I remember in the U.S., we do have on average 2 vehicles per household. And so we always say don't sleep on the U.S. EV market, because the burden of EV adoption over the next few to several years really requires more households to wake up and say, hey, life is more exciting with one ICE and one EV in a household fleet as opposed to 2 ICE vehicles. And so eventually we do see, particularly as EVs continue to innovate, prices continue to come down, potential for EV demand growth in the years ahead. And it's important for automakers to be positioned for that, or else risk being left behind in the next wave of demand. And so GM's current EV portfolio and capacity, we still believe position them well to capture these opportunities over time, particularly in certain U.S. Markets, such as the lucrative coastal markets, where GM's market share historically has been quite low.
Itai, if I'm a Tesla investor and I saw that GM headline, what am I thinking?
There's really not much of a read through there, just because it's sort of GM's reaction to previous plans that now have had to go through a change. Of course, the key focus for Tesla here are the new models being launched globally, and of course here in the U.S. just recently. And so we'll look for earnings on potential updates to initial demand and order trends there. So I'd say it's a bit of a different kind of storyline for where Tesla is relative to GM news today.
Itai, Pras, great to have both you guys. Thank you. Coming up when we return, should NVIDIA be worried about AMD and Oracle's partnership? Stick with us. Oracle is making a big bet on AMD, announcing plans to deploy 50,000 of its AI chips starting next year, potential alternative to NVIDIA's market-dominant GPUs. For more, we're bringing in Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, this is obviously a huge win for AMD. This comes on the heel of their prior deal with OpenAI that saw OpenAI get upwards of 6 gigawatts of GPUs. Now, just to put that into perspective, there was a Reuters report a while back that said about a gigawatt can power about 700,000 homes, 800,000 homes around there. And so you kind of get the idea of how many GPUs that really is. In that deal with OpenAI got about 10%, equivalent to 10%, or has the option to get stocks worth upwards of 10% of AMD. This deal, we're not getting that kind of in-depth detail, but 50,000 GPUs for Oracle. Now, you mentioned NVIDIA. What does this mean for them? It does kind of show that AMD is starting to kind of gain ground, make a little headway as far as NVIDIA goes and the overall AI market. But I don't think NVIDIA has anything to worry about at all at this point. I mean, they have a $300 billion deal with a $100 million deal with OpenAI. They're working with Oracle as well. They work with Microsoft, Google, Meta, XAI. I mean, you name it, they're working with everyone. So I don't think that they have to worry about anything. I don't think they're necessarily, quaking in their boots. But it is something to keep in mind as we continue to see these huge AI investments go on, that AMD is starting to gain a little more traction in this space.
Speaking of chips, Intel news as well. What are you going to tell us about that one?
Intel has a new kind of data center chip. It's a GPU. It's codenamed Crescent Island. And they also have a new rack scale reference design that's based on their Gaudi 3 systems. Now, this is important as Intel kind of continues this turnaround effort that they're undertaking. It also is important for them to expand into the AI space. They do have Gaudi 3. They're basically PCIe chips. To explain it to you, when you have a rack, like what NVIDIA talks about, they have racks, right? And you kind of slide those into servers. These can also live in racks, but you kind of just drop them in or slot them in, even into a regular PC if you want. It's a similar kind of slot. And so that's what Intel is working on here. It's Probably not going to make as many waves as anything that NVIDIA has to offer or AMD has to offer, but it is important as part of their broader turnaround effort to push into AI, as well as their effort to expand and grow beyond the client space, which is still their biggest business line, the client PC space. And so, that coupled with their foundry efforts, it really is kind of starting to appear as though we're getting the early innings of some kind of turnaround going forward for Intel. We just have to continue to wait and see.
All right, Dan, thank you. Appreciate it. All right, now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma. Join me now with a look at Walmart, Domino's, and Albertsons. We're going to start with Walmart. The retailer teamed up with OpenAI to create a ChatGPT shopping experience. So this one was interesting, Brooke. So Walmart and OpenAI, apparently this is going to let shoppers, browse, buy products on ChatGPT. Walmart executives telling reporters this is an opportunity to deliver convenience in a way that meets customers where they are. New function apparently launching in the fall. Walmart leaning into AI here.
Yeah, absolutely. Walmart's been really leaning into this idea of just creating a more convenient experience for their consumers. And that's why you're seeing the run-up of the stock year to date. It's been outperforming even Amazon, other retailers like Target. And it's, the CEO said within this note that this is all about to change when it comes to e-commerce shopping experiences. CEO Doug McMillon said that there is a native AI experience coming that is multimedia, personalized, and contextual. Once again, it's part of that broader AI strategy that they've been ramping up. We saw e-commerce profitability for Walmart's U.S. e-commerce business increase or rather turn profitable for the first time in Q1. That increased again in Q2. They're also investing in that Sparky, that basically chatbot, an AI-powered assistant on their website. So keep a lookout for that as well. But keep in mind, a partnership with OpenAI certainly does quite literally open the doors for Walmart. OpenAI has about 700 million active weekly users. And so that could really, lend the opportunity. Essentially how it'll work is, you type in what you want, and then Walmart is one of the first offerings that come up, and then you're able to buy it within that function. And so this could really open the doors for Walmart to gain access to those users who maybe don't shop at Walmart typically.
All right, here's another name on the radar. Domino's Pizza. Those shares heating up as the company reports better than expected comp sales growth. So this one, Brooke, all right, so better than expected quarterly results. You saw U.S. same-store sales. Those rose 5.2% in the third quarter. That was a beat.
Better than
EPS
expected,
clocks in at 408, also a beat. And they did say comparable sales could be pressured by the macro, but it looks like they're still confident they can hit these 2026 targets, 3% U.S. comparable sales growth.
Yeah, and what we're seeing right now is investors are certainly pleased with these results in this macro environment. Consumers are looking for value. And there was two things that drove those U.S. same-store sales higher. CEO Russell Weiner said on the call that the best deal ever was something that was supposed to be short-lived, but now franchisee owners are asking for it even longer, saying that they want to continue to lean into it. It's driving business in their stores, and it's also driving profitable business. Now, that best deal ever is $9.99 each for a pizza with as many toppings as you want, so consumers really seeking out value in this environment. In addition to that, their stuffed crust pizza, well, that also sold, that also boosted U.S. same-store sales growth. Fun fact here, they actually said if you took all the cheeses that are in the stuffed crust and you line them up, it'll circle the earth. That's just how many they sold this past quarter. But really, they're leaning into this, what they call unique discount offerings in this time where consumers are really facing, this macro uncertainty. And it worked for them this past quarter.
I like to think about some Domino's IR, investor relations department person.
Figuring out how to conceptualize that.
Stock is basically flat year to date, but most in the street, they like this one. They say it's a buy. All right, finally, lastly, Albertsons raising its full year adjusted earnings guidance. That stock seeing a jump in today's trade. So the gross reports Q2 results, Brooke, better than expected. Looks like they boost their annual EPS guidance. I do see Citi analysts cited here as saying expectations were low, they say, coming into the quarter. They do have a buy on this one, targets 26.
Yeah, JP Morgan expressing a similar notion there, saying that this was positive, especially considering that those were such low expectations going into the quarter. Two things that boosted this quarter for the company were their pharmacy as well as
their actual private label business. So on the call, the CEO had noted that what they've seen from the consumer is a continued focus on value, a shift to trading down, maybe it's smaller packages sizes, and also a focus on its own brand. So essentially those private label brands, that's something we've been hearing for quite some time, is consumers really turning to those private label brands. Watch out for PepsiCo and Coca-Cola, because that could create some problems for these CPG brands as well. And in addition to that, they said their pharmacy business also was pretty strong this past quarter. They said that it grew 19% year over year, fueled by the continued demand for GLP-1 drugs, strong core prescription volumes, and also shared gains from competitor store closures. So perhaps those more traditional drug stores closing around them, they saw those consumers then turn to Albertsons to, fulfill those subscriptions.
Yeah, it's interesting commentary, the CEO talking about shoppers, talking about increased usage in coupons, sticking closer to their shopping list, maybe not buying that extra item.
A very budget-focused consumer right now.
Thank you, Brooke. Appreciate it. Aura, the maker of smart rings, announcing a $900 million fundraising round on Tuesday, bringing its valuation to $11 billion. Julia Hyman spoke with the CEO on Morning Brief and first asked him what his plans to do with that capital.
The first thing, of course, is AI. It's no surprise that high quality data continuously collected is what's required to make really accurate predictions and inferences about your health. And that's an area of investment that we've been investing in for several years, but I think we really want to take it to the next level. The second thing, of course, is international. Today, we're largely a business focused in the United States, but we want to take our business on the road and expand around the globe. And we expect to see that drive growth for the next several years. And then the final thing, of course, is we are mission driven, and our mission is to make health a daily practice. What we expect to be able to do is to start to work our way into the healthcare industry. Today, we work with insurers. In the future, we expect to work with insurers and providers and clinicians, and expanding our product platform and technology platform to work in hand with traditional healthcare is a big part of our investment going forward.
So, Tom, put some of that together for me, in particular the AI and the healthcare piece, because ideally, one would see a future where you could use a tool like an Oura Ring or whatever tracker you're talking about to be predictive, right? To say you're at risk for a heart attack or what have you. Here's the signs. Here's what you need to do. How far away are we, or are we already there in terms of that kind of functionality?
So today, for example, Oura can look at your biometrics and make a prediction about your health status in a couple of days. The feature is called Symptom Radar. It looks at several biometrics, looks at what's normal for you, looks at the trends in your health, and can say something like, "Hey, you're showing major or minor symptoms that are expected for you in the next couple of days." And that's a very short time horizon prediction. This has been incredibly useful for lots of people. I used it personally to help stay healthy when I'm traveling. I'll take a day and rest and break so that I can recover without getting sick. But it's really surprising and powerful how accurate it can be. You think you don't feel any symptoms at all, and then 3 days later, you're on the couch watching Netflix surrounded by Kleenex. This kind of prediction, that's a short-term prediction. But the density of data and the quality of data that we can collect, including data from the ring, but also data from outside, things like I'm wearing a glucose monitor right now, or we recently introduced blood biomarkers where you can actually sign up and get those tests taken, and then we'll bring them together inside of your Oura experience. Adding all that data together lets us make longer term predictions. And I think the way to think about this is that it's almost like a doctor in your pocket. You've already got a supercomputer in your phone. You've got a device on your body that's measuring, kind of clinical grade data on a constant basis and looking at you overnight, which means your body's at rest. So we get a very good signal, and then feeding that information to a machine intelligence, which is looking over you. And it's not just the doctor, in your pocket that's sort of saying, "Hey, something's going to happen to you. You got to watch out for." It's also trying to steer your behavior in kind of that preventative medicine way, where it's trying to influence your behavior to help you live a longer and healthier life. AI is the foundation of all of that. And if you think about medicine today as being practiced on the averages, and you go to the doctor once a year, the difference is that this AI will be personalized to you. It'll be custom to you. It will know your data, your context, your genotype, your phenotype. In the future, that's the future of medicine. And it's not only personalized to you, but it's also predictive and can work with your clinician to help them understand what's going on with you, like a co-pilot for your doctor.
Tom, I have so many questions for you. I'm curious what you make of the sort of criticism of this type of hypervigilance and transparency of the data, that it actually increases anxiety, can increase, sort of overdiagnosis or misdiagnosis in some cases, because you're people can obsess over having all of this information.
Philosophically, I think our approach is that we want to recede into the background. We don't want to be reminding you every day of your mortality and to create some anxiety. We try and make the experience be as low impact as possible. I think that's actually partially because we don't have a screen on the device. It just sort of is there monitoring you like a guardian angel in the background. But when you need it or want it, it's available to you, and you can investigate it at your leisure. Now, that being said, there certainly are people who I think become overly obsessed. I don't know if your husband talking to you every morning about his sleep score qualifies, but the point is that the information is power, and that power, you can use it to live a healthier, longer life. And I think that's incredibly important. The idea is to give you agency in your health journey. And I think this is a trend that's been going on, for decades, as people have learned more and more and gained more access to health information. Scientific papers are available on the internet. Everyone can become an expert. Now, that being said, we don't want you to be obsessed. If you are obsessed, please, take the ring off. Give yourself a break, because one of our core values is that you should live a life of balance. And balance means, finding the right, set of circumstances for you in your life where you are. We want to meet you where you are right now and give you the power to drive your own health journey and not be just a passenger on the bus.
Coming up, we're drilling down on those important bank earnings and what signals they give us about the economy. That story and more coming up. Big banks kick off the third quarter earnings season. Goldman and JP Morgan seeing their quarterly profits boosted by a flurry of Wall Street deal making, but JP Morgan Chase CEO Jamie Dimon still highlighting significant risks persisting, including trade uncertainty and high fiscal deficits. Here to discuss this and more, we have HSBC Head of U.S. Financials Research, Saul Martinez. So great to see you as always. Let's start there. So with JP Morgan, because those comments from CEO Jamie Dimon certainly get attention, making some headlines. Mr. Dimon calling out weaker job market, inflation. I see JP Morgan, looks like they did report $3.4 billion of provisions for credit losses. Bloomberg noting, Saul, that was slightly higher, it looks like, than analysts had expected. We know Jamie Dimon, he can tend to sound more cautious, but I'm just curious, what did you make of those comments? Does it affect in any way, Saul, as a financial analyst, how you think about the stock?
No, and thanks for having me. Look, I think, Jamie is pointing to what we are seeing already. Just in the last few weeks, we had, the Tricolor debacle, First Brand, bankruptcy. CarMax had difficult results. So there has been greater concern in the market, and you actually seen it in the last couple of weeks in bank stock prices. Bank stock prices have been hit a little bit, and you've seen it in the alternative asset managers as well, who have been hit much harder. So there are these concerns about credit overall in the economy, and I think what Jamie is doing is he's pointing out that there are pockets where largely outside of the banking system, but there are pockets where there are where maybe folks got overextended, and there could be losses. And so he is pointing out something that that there may be some fragilities that exist out there. That said, even in the case of JP Morgan, but in the results of Wells Fargo and Citigroup, overall the credit performance was a relief, not something that's causing people to worry. And I think that's part of the reason you're seeing the stock prices react well. The commercial loan portfolios are performing reasonably well. Consumer portfolios are performing well. So thus far, the bank credit dynamics seem to be favorable, but certainly it's something you have to pay attention to, because we are seeing some pockets of weakness in the credit market, and That's something that Jamie pointed out this morning.
Just looking at JP Morgan stock here, so it is down about 2% in today's trade. What do you think explains that?
Look, it's interesting because one of the takeaways from this morning is just how divergent the stock price reactions have been. Overall, if you look at bank stock, not just those who reported today, but more broadly, they're reacting well to these results. I think in the case of JP Morgan and Goldman Sachs, it's a reflection of expectations. Expectations are high for JP Morgan. The stock trades at 2.9 times tangible book value and has done extraordinarily well. And I think that there are a couple things to point out. These were good results, don't get me wrong. But net interest income, the guidance for the initial cut for the outlook for 2026, net interest income excluding markets, $95 billion, may have been a little bit soft relative to what some people were expecting. And they also highlighted that expenses for next year are likely going to be higher than what the consensus number is, which is about $100 billion. So given really high expectations and good results, but maybe some areas where the market was expecting a little bit more, that's a recipe for underperformance.
So about Wells Fargo too, so I want your take on that. Asset cap is removed. What did you make of that report and what's ahead? The CFO saying this is one of the best franchises in the country.
Yeah.
You agree with that?
For sure. I mean, it is, really, Wells Fargo, Bank of America, and JP Morgan are the three national banks. And Wells Fargo has been hamstrung by the asset cap, and the asset cap has been lifted. So, there are some opportunities to grow the balance sheet. I think, my diagnosis of JP Morgan, where expectations are high, I think the opposite could be said for Wells Fargo. I think there were some concerns coming into the quarter about whether they might have to lower their guidance for net interest income for the full year. The guidance is flat for the full year. And they reiterated that guidance and gave fourth quarter guidance for net interest income that was pretty strong, and that showed a sizable uptick versus the third quarter. But the underlying trends are good. Loan growth is getting better. Fee momentum has been good. And I think importantly, what they said was, they gave a medium-term guidance for returns on tangible common equity of 17 to 18%. They're kind of at the 14, 15% level. And so that I think was encouraging to folks because it did suggest that management is confident that the trajectory for profitability is moving higher in the coming years.
You mentioned Goldman. I want to circle back on that one too, Saul, because that's another one down about 2% in today's trade. Is that just expectations, or were there questions about expenses as well?
I mean, there could be some questions about certain things in the results. Overall, the results were good. Now we have a reduced rating on Goldman and on JP Morgan because our view is that we're really pricing in a lot, and there's a really high hurdle to get over for these stocks to outperform over an extended period of time. And I think the results for Goldman and JP Morgan sort of reflect that today. These were good results. These were really good. Investment banking up 42% year on year. Sales and trading was up low double digits. You did, if you wanted to nitpick anything, the equities sales and trading was not as strong as I think what was expected. There was a little bit of cost pressure, but they still did positive operating leverage. I think really with Goldman is the expectations, given the resurgence in capital markets activity is really high, and it's to meet that hurdle is more challenging. You really have to believe in the case of Goldman, in my view, that consensus earnings expectations and my earnings expectations are too low if you want to get upside. And these results were good, but they didn't change the narrative per se. And I think the soft stock price reaction is a reflection of that.
So you have a reduce on JP Morgan, so we got a reduce on Goldman. You have a buy on Citi, right? So let's talk about that, because that one's in the green today. Looks like they beat the street's revenue estimates across all 5 of the major business lines. Total revenue looks like jumped 9%. What do you make of that report?
They were really strong results. I think the story for Citi is that they are on the right track in terms of getting profitability, returns on tangible common equity, higher over the next few years, and that will allow for price to tangible book value multiple expansion. They trade at only 1 times tangible. And I think the results really showed that. They had showed really good momentum across businesses, positive operating leverage across all the business segments. I think Jane Fraser and the management team are doing a good job of really improving business performance. The outlook there for next year, I think, is a positive one. We expect revenue growth. They expect revenue growth. The cost per four, there are multiple levers they can pull on cost. So there's good line of sight on operating leverage. There's capital flexibility. They bought back $5 billion of stock so they can rationalize the capital base, and they're buying back stock at tangible book value, not 2 and 3 times tangible book value. So that's a plus. So it's just another. I think for Citigroup, it's about management building credibility because they have disappointed so much in the past. That if they continue to deliver quarter after quarter towards driving up higher ROTCEs, they climb that wall of worry, and the multiple expands over time, even as they grow their book value per share. So I think this is a stock that has some legs and can really outperform for some time.
So always great to see you. Thank you.
Likewise. All right.
We got breaking news. Markets losing some steam into the closing bell says the president issues another threat against China. President Trump posting, "I believe that China purposefully not buying our soybeans and causing difficulty for soybean farmers is an economically hostile act. We are considering terminating business with China having to do with cooking oil and other elements of trade as retribution. As an example, we can easily produce cooking oil ourselves. We don't need to purchase it from China." The S&P 500 and the NASDAQ now in negative territory for the day in what's been a wild day on Wall Street. Well, coming up, we're wrapping up today's Market Domination. Don't go anywhere. We got you covered with all the action. Follow the closing bell. Stay tuned for Market Domination. Over to you.